Hey, welcome back to the channel. This is Michael Neuenschwander with Outlook Wealth Advisors. Today we're going to talk about Trump's big, beautiful bill. Now, if you'll bear with me, we're going to nerd out into some tax law here just a little bit. But as we look at it, we need to recognize, too, that the big, beautiful bill was not just a tax bill. It was a tax and spending bill. So for today's video, we're going to focus more on the personal side of the taxes. Now, a lot of it, obviously, we hear the news and say, okay, well, the bill over the next 10 years may add, X trillion dollar, to the deficit. However, when we look at saying, regardless of political spectrum, right or left, our job today is to say, well, let's deal into the provisions that actually may impact your personal tax return. Now, certain things we're going to touch on. So if you're a business owner, there's some other credits that have been extended that may help you on the business side. That's certainly something we could dive into more. But today we're focusing really on I call it the bread and butter, the nuts and bolts of what may impact, sort of the normal, retirees, normal working families, and how that impacts their taxes, and which parts of the law are, quote, permanent, and which parts are automatically have some expiration dates, as well. First, we'll kind of get, the cost of the tax bill out of the way, though, just briefly, because it says no matter what, happened, from purely a budgetary point of view, this bill was always going to add to the deficit, simply meaning the calculations of the deficit were all built on assuming tax rates went up at the end of this year. Because as a refresher, that is what the current tax law says. If Congress did not pass anything, tax rates go up at the end of the year, standard deduction goes back down. And so by simply extending the tax rates, which is what the big bulk of things we're doing, simply extending the tax rates at the current historically low levels was going to add to the deficit either way. So now that we got that sort of out of the way, then let's talk about what was really in this bill that may impact you and your retirement and your overall tax plan. One of the biggest things that was mentioned on the campaign trail, of course, was, can we make Social Security tax-free? To put it simply, that did not make it into the bill. Various procedural reasons in terms of why they couldn't add it, but what they did instead is they said, well, let's give everybody a $6,000 additional deduction, for quote, Social Security. Now, that Social Security deduction does not really have anything to do with whether you're collecting Social Security or not. It's really just an additional deduction that you can take when you and your spouse or your spouse, so together, are over age 65. So it's $6,000 per person, so $12,000, per couple. However, that deduction also phases out, which means if income is below $150,000, you get the whole $6,000 per person. As you get above $150,000, between $150,000 and $250,000, that deduction goes away, ultimately, going away altogether. So in one sense, if your income's above $250,000, you can say in that regard, taxes really didn't change much from 2024. It says tax rates were carried over the same. You don't get the extra deduction. You just potentially get the standard deduction or itemized. We'll talk about that as another place that changed. So first, that $12,000, what does that actually mean for most people? So if we use call it a somewhat typical retirement picture, it says a couple, they've got income of around $100,000 coming between Social Security, investments. Maybe they're fortunate enough to have some pension. But at that level, it says, well, $120,000, you're essentially right there edging into that 22% tax bracket. So if you have an extra $12,000 deduction, well, $12,000 at 22% says it's going to save you roughly $2,400 in taxes. Now, if you're in the 12% bracket, you can do the same math and say, well, that $12,000 at 12% saves you about $1,400 in actual tax. So either way you slice it, you are going to pay less taxes because of that extra deduction. So that's the good news. Part of what was in there says they couldn't make Social Security tax-free, but they can at least give you a little bit of an additional deduction. Now, also to be clear, that additional deduction applies whether you take the standard deduction or the itemized deduction. So it's essentially a separate category on top of that. Now, speaking of the standard deduction, the other thing you may have heard is they increased the standard deduction. What they really did is they brought it forward by about an extra year, meaning the standard deduction has been indexed for inflation for the last, 8 years. And so it goes up a little bit every year. They essentially just increased it an extra $1,000. plus the increase for inflation. So it got a little bit bigger. So if we're talking for a couple age 65, a retired couple today, that standard deduction for 2025 ends up being approximately $33,000, and then again plus increases for inflation, over time. The other big change you may have heard about is what's called the SALT taxes. Now, for us locally, think of that. It's your state and local income tax, but for most of us, that means property taxes. So property taxes have been limited, or this whole category, we could say, has been limited to $10,000. Now, under the new law, that takes it all the way up to $40,000. But it's $40,000, again, only for 4 years. And also, let me reiterate, if I left it out, that extra deduction, the Social Security deduction, is only for 4 years. So a little preface if it says, the change to the tax laws, supposedly for the tax rates, is, quote, permanent. And a couple of things we're touching on automatically expire in 4 years. However, let's be honest, when we look at what is called permanent in tax law, and when we go back and say, how much is this bill going to add to the deficit projections are going 10 years out. Permanent in tax law really just means until a new Congress or new White House is in control and they want to change it. So in either case, I don't think we're going to see this bill 10 years down the road. It's going to be changed before that. So all of these projections of the deficit, or you have this rule is in force for so long, the reality is those will change too, which does bring us to an opportunity that we'll talk about towards the end of the video. But just keep that in mind that most of what we're talking about today, either some of it has some automatic expiration dates in 4 years, or even things that don't automatically expire can be changed at any time by any future Congress, as well. So going back to the SALT taxes, it says largely that was a push from East and West Coast, where they have much higher property taxes, much higher home values than what we have, here in Texas. And so that push for $40,000 was so that they could deduct more of their property tax, but also their state tax. Now in Texas, of course, we don't have the state tax, but what we do have, we have our property taxes. You can also add taxes you pay on the purchase of a vehicle. So major purchases, the sales tax we pay also gets added into there. So okay, great, Michael. So we got a $40,000 limit instead of 10. This opens up an opportunity in terms of some things that people used to do. Maybe one strategy is to consider paying your property taxes twice in 1 year again. So you can pay them in January and then pay them in December. That way you can take the deduction for the entire amount, and you may end up saying, well, you essentially go back to having an on year versus an off year. 1 year, you throw all the deductions you can into the pot to get above that standard deduction. The next year, you then take the standard deduction. So there's a few strategies like that that may come back into play thanks to this new tax law. The other thing to keep in mind, though, with these SALT taxes, even though that category has now been extended up to $40,000, it still has to get you above the standard deduction hurdle. So what do I mean by that? There's really only a handful of things that go into itemizing your deductions. One, if you have a whole lot of medical expenses, but keep in mind medical expenses are out-of-pocket medical above 10% of your adjusted gross income. So a big portion of it doesn't apply. You have the state and local taxes we were just touching on, so largely property taxes and sales tax, or if you pay state taxes in other states, that counts as well. And then you have mortgage interest, but if you're retired or close to retirement or you have no mortgage, well, then that may not be much of a big category. And then the last one is your charitable contributions. So again, as we touched on, if the new standard deduction becomes $33,000, even if you have $20,000 in property taxes to deduct, if you don't have big medical expense, you don't have a mortgage, and in that scenario, you're not giving away at least $13,000 a year to charity, just because you can deduct the extra property tax doesn't mean you got above the standard deduction. So for a lot of people, what sounds good on paper may not really amount to much, in that SALT tax increase. A few other things that did change too is they're ending the they call them the EV credits, a lot of the green credits. So those are going away in a very short amount of time. So if you were on the fence on getting an electric vehicle, you need to act quickly. The other thing they did put in is if you're buying a vehicle that was final assembly in the U.S., well, you can deduct the interest you pay on that loan. Now, again, that may or may not help you, because if you're in a position where you're simply paying cash for that vehicle, well, then being able to write off interest doesn't mean anything to you. So a few things there. The other parts, when we look as well, what didn't change? And this is a big deal for most people. So the extension of the tax rates is largely the biggest deal for most of us, just saying, here's where taxes were supposed to go. And on average, if we looked at where they were supposed to go, 12% became 15, 22% to 25, 24 to 28, etc. For the most part, tax rates were going to go up between 14 and 20%. So the fact that that didn't happen, that's actually the biggest benefit for most people. The other things that did not change, though, that you still have to be aware of, when they talk about the Social Security deduction and it being phased out, they're really using or looking at a term called Modified Adjusted Gross Income, or MAGI, M-A-G-I. That's also the same thing that they use for adjusting IRMA, which is how much you pay for Medicare. So those parts of the rules did not change. So even though the tax rates stayed the same, maybe you got larger deductions. However, IRMA looks at your income before deductions. So those parts of the rules didn't change. Roth IRA strategies also are still available, so no changes on there. And the fact there's still a big difference between married and single rates. So for a lot of people, what I'm encouraging you to look at is, yes, we got an extension of those lower tax rates, which is beneficial. Maybe we got a temporary increase in your deduction, thanks to the Social Security deduction. Maybe you got a little benefit from the SALT taxes, but for a lot of people, not much. So think of it as we still have another 4-year window where taxes are at historically low rates. And so when you think about your overall retirement and tax strategy, rules around required distributions didn't change. You're still going to have to take a required distribution, there at age 73 or out to age 75, depending on your age. Roth conversions may still be a good strategy. Make sure you subscribe, because we've done several videos talking about the math and the logic and the reasoning behind Roth conversions to see if those fit you. But when we look at it, this may be a golden opportunity to say, for 4 more years, we know taxes stay low. And maybe you have some extra deduction because of the age 65 deductions. But at the end of 4 years, my belief is truly that ultimately taxes go back up. We've seen it, on the political spectrum, that pendulum swings both ways. Before we were a little more left, now we're more to the right. But if things swing back the other way, whether it's in 4 years or 8 years, there's a very high likelihood that changes are going to happen on the tax side, and it may not be to the benefit of us as individual taxpayers. The other thing I can almost promise you, it's a little morbid to think about, but if you're married and watching this video today, we're not allowed to guarantee much in this business, so I can almost promise you that your taxes are going to go up. Because if something happens to you or a spouse, largely in retirement, you retain most of the same income. The smaller Social Security check may go away, but if you made a decision on pension, lump sum or pension or single life versus joint life, that pension largely remains, the larger Social Security check remains, the required distribution amount remains. So for many people, if something happens to one spouse, even though your income may go down some because of that loss of one Social Security check, your tax bill actually goes up. So when we think about your tax strategy and your retirement in the long run and how this big, beautiful bill impacts things, it may have just given you another 4 years to be proactive on your tax strategy to say, how do you make sure that in the big scope of your retirement, you're at least doing as much as you can to save taxes on the long run for you, for your spouse, and potentially for some legacy planning as well. So I hope today's recap and a little deeper dive into the big, beautiful tax bill and how it helps you personally, or how it impacts you personally, was beneficial. If you want to make sure you stay on top of information like this, or you want to make sure you are able to see the other videos we've done where we take a deeper dive on Roth conversions, or we talk about the best decision between pensions versus lump sum, make sure you subscribe and continue to join us on other videos. Thanks again. Have a great rest of the day.